You are watching Market Watch, the brief overview of the key events from the world of finance. All attention is on the publication of the U.S. inflation report. Professional investors and traders are trying to use this report to determine the probability of a change in the key interest rate by the Federal Reserve. At the same time, another indicator is rarely voiced, which is an integral part of the full picture of what is happening in the economy: the unemployment rate. Of course, you can dig deeper and note the number of jobs created in the non-agricultural sector, as well as the level of business activity and a number of other indicators. But basically, we are talking directly about the unemployment rate, which increased in February, but still does not exceed the maximum figures for the last 2 years. Therefore, there is no good reason to ease monetary policy until inflation reaches the target level of 2%. Since unemployment remains at a very low level, even if we recall the values before the pandemic, and at the same time, inflation is significantly higher than 4 years ago, so it is quite logical to assume that before an obvious decrease in inflation, the Fed can keep the rate at the current level. Consequently, an unexpected excess of the projected growth rate of this indicator can have a strong impact on the market. Recall that the consensus forecast indicates a 0.4% increase in the Consumer Price Index in February. This is far from the highest value in the last 18 months, during which we have observed a general slowdown in this indicator. But even a slight excess of the forecast practically guarantees the fact that in March and most likely in May, the Fed will leave the key interest rate unchanged. This is a very strong bearish fundamental factor for all risky assets, ranging from stocks to commodity assets and cryptocurrencies. Let's pay attention to the key U.S. stock indexes. They slowed down significantly ahead of the release of this report, while Bitcoin continued to grow, approaching the $73,000 mark. Rapid growth always carries the risk of a deep correction, because even a slight decrease can be a reason to take profits on long positions. Technically, this is a sale, therefore, there will be an increase in pressure. As strange as it may sound, the publication of inflation data in the United States may have the strongest impact not on the US dollar or the stock market, but on Bitcoin and other cryptocurrencies. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.